Good morning.
Morning.
Good morning.
Yeah,
Morning.
we've obviously been experiencing some technological difficulties, so if something happens during the course of the hearing and you can't hear me or us, wave your hands or something, and we'll try to get the problem corrected. We're on the record in case number 2020-00016, electronic application of Louisville Gas and Electric Company and Kentucky Utilities Company for approval of a solar power contract and 2 renewable power agreements to satisfy customer requests for a renewable energy source under Green Tariff Option Number 3. My name is Michael Schmidt. I'm chairman of the Public Service Commission, and with me today remotely is Vice Chairman Kent Chandler and Dr. Talina Matthews. At this time, I would normally caution attendees to please set your cellular phones to silent mode or turn them off. Due to the current state of emergency in Kentucky, the Commission is hosting this hearing via video conferencing. In addition to the normal courtesies regarding cell phones, these tips may help with clarity and avoid feedback issues for the video conference hearing. Mute your microphone if you are not speaking. Attorneys, when interjecting, please state your name so the video record is clear. If you use a phone for the audio and a computer for the video, turn off the computer audio. Otherwise, there will be feedback. If you are in a room with several people on their own computers, turn off the computer audio for all but one computer. Otherwise, there will be feedback. If another participant is in a nearby office, close the doors between the offices. Sound carries further than one thinks, which can cause feedback. Once in the GoToMeeting software platform, go to your settings. Icon looks like a gear to ensure the microphone setting is on the microphone you are using. There is a pull-down menu feature in GoToMeeting settings that will list the available microphones. Use wired headphones or wired earbuds for better sound quality. Wired is preferred because wireless devices may lose power depending upon the length of the hearing. Keep a charger nearby in case your battery runs low. And please alert the Commission if you are experiencing technology failures that prevent your participation at any time in the proceedings. Attorneys should contact staff at the previously provided cell phone number. The hearing today is for the purpose of taking evidence on Louisville Gas and Electric and Kentucky Utilities' request for a rehearing on the methodology to be applied to recover costs from the portion of the solar purchase power agreement that serves native load. Parties to this proceeding are Louisville Gas and Electric Company, Kentucky Utilities, and the Office of the Kentucky Attorney General. At this time, would counsel for LG&E and KU please identify himself or herself together with co-counsel and the witnesses who will be presenting testimony here this morning. Mr. Riggs.
Good morning, Your Honor. Kendrick Riggs with the law firm of Stahl, Keenan, and Ogden, appearing on behalf of Louisville Gas and Electric Company, Kentucky Utilities Company. Also appearing with me this morning is my co-counsel and colleague, Ms. Allison K. Sturgeon, Managing Senior Counsel, Regulatory and Transactions. Appearing here at the hearing today and on the screens, Your Honor, are our 3 witnesses, Mr. Lonnie Beller, Mr. Robert Conroy, and Mr. Chris Garrett.
Thank you. And for the Office of the Attorney General.
Good morning, Chairman. On behalf of the Attorney General, I'm Lawrence Cook, and with me here today is my co-counsel, John Horn.
Thank you. And for staff.
Nancy Vinsel for PSC staff.
Thank you. I checked the record this morning and have found that public notice has been given as required by statute and regulation. So at this time, if there are no outstanding motions or nothing council wishes to bring to the Commission's attention before we start, we'll ask for public comment. Mr. Riggs, do you have anything that you'd like to bring to our attention before we begin?
No, Your Honor.
Mr. Cook, Mr. Horn? Anything?
No, Your Honor.
Thank you. All right, Ms. Vinsel, are you supervising the public comment section here? So at this time, you are, so let me read our entry. Should anyone from the public like to provide the commission with public comment, instructions to call are located on our website, psc.ky.gov. The phone lines will remain open for several minutes at the start of the hearing and close if there are no callers or after everyone has had an opportunity to speak. Should you call in, please state your name and address for the record before making your statement, and please keep your comments to 5 minutes or less. If there is more than one caller, please be respectful and allow one person to make a statement at a time. It should be noted that comments may always be submitted on the PSC's website at psc.ky.gov. So at this time, we'll wait a couple of minutes to see if anyone would like to call in and make a comment.
Good morning. This is the Kentucky Public Service Commission. Is there anyone on the line to make a public comment?
All right, there being no one on the phone line to make a public comment, we'll now begin with the consideration of the testimony. Are there any exhibits that the parties intend to introduce during the course of this hearing, and if so, have they been distributed or identified to other counsel?
Your Honor, our evidence is completely filed in the record in this case.
Got Mr. Cook?
None on behalf of the Attorney General, sir.
Okay. Ms. Vinsel?
Chairman, no. Staff will only reference documents in the public record.
Thank you. All right, before we, I guess, call witnesses, let's just swear all of the witnesses in at the same time. So, Mr. Beller, Mr. Garrett, Mr. Conroy, would each of you please raise your right hands? Do you solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. All right, Mr. Riggs, you may call a witness.
Thank you, Your Honor. I plan to present all three of our witnesses as a panelist. I'll begin with Mr. Beller. Mr. Beller, would you please state your full name, business address, and title?
Lonnie E. Beller. My business address is 220 West Main, Louisville, Kentucky. I'm the Chief Operating Officer for LG&E and KU.
Mr. Conroy, would you please state your full name, business title, and business address?
Yes, it's Robert M. Conroy. I'm Vice President of State Regulation and Rate. Business address is 220 West Main Street, Louisville, Kentucky.
Mr. Garrett, would you please state your full name, business title, and business address?
Controller, 220 West Main Street, Louisville, Kentucky.
Mr. Beller, Mr. Conroy, Mr. Garrett, filed joint testimony with the Commission in this rehearing phase of this case on September 18th, 2020. If I were to ask you the same questions in that pre-filed testimony this morning, would your answers be the same?
Yes.
Yes.
You adopt and affirm that testimony as your testimony this morning?
Yes.
Yes.
Now, Your Honor, Staff Counsel had requested the companies to make a presentation of the methodology that they proposed. And I would ask the Commission, if it would, to present the PowerPoint presentation that was used at the August 25th, 2020 informal conference. If that could be brought up to the screen, please. And if we could move to page 15 of that PowerPoint presentation.
Okay. Please give me one moment to bring it up.
Sure. Your Honor, I would note that the camera does not seem to pick up or focus on Ms. Densel when she speaks.
We've been having some, obviously, technological problems this morning, the source of which remains unknown. We'll see if we can. Apparently, the system was tested yesterday, and everything went perfectly. And of course, in this morning, we've had issues.
Of course. I often ask myself, when I'm in a similar situation, what changed? What happened? And I'm yet to find an answer to that question.
Well, I really hate to say this, but I'm having a technical issue bringing up the document.
Can you do it?
Why don't we, I guess we're going to have to get some assistance in here. Why don't we
You'll give it a minute, right?
I was going to suggest if we're going to move ahead, we have Jim, our IT man, is here. Do we have? Okay, is that
There we
right?
go.
No?
No.
Why don't we take a 5-minute break until we can see if we can get this accomplished? Well, we're up now.
There, yes.
Let's keep our fingers crossed.
Thank you, Jim.
This on my screen, yeah.
Okay. All right. There you go, Lonnie. And you want to go to the next page?
Yeah. All right, and may I ask that the presentation be moved to the next page, please?
Okay.
All right. Mr. Beller, I'm going to, go ahead, please.
Can that be enlarged?
Yeah.
Are you presenting that? Yeah. Okay. That is as large as we can present on our screen, Larry, I'm sorry.
That's fine, I can make do, thank you.
Larry, if you go to the right of your screen, there's a zoom button, and you can make it bigger on your own screen. At the right at the bottom.
You've got to hover over the right-hand corner, make it appear.
And then, Mr. Cook, if you want to go to the very top of it, where it says everyone webcam, the third item at the very top says Zoom, and you can choose the amount of Zoom that you like.
Mr. Beller, the company in its rehearing testimony has proposed a methodology that uses the AFB and FAC processes along with a purchase power solar power rider. Would you please review how the company's proposed methodology works using the examples that were presented in the PowerPoint presentation at the informal conference? These same examples appear in your testimony.
Sure. As I go through this, I would just ask those listening in, if you have any questions, please stop me. The proposal, as Mr. Riggs outlined, utilizes information available from the AFB program that we utilize here at the company, the fuel adjustment clause, and it supports a process that will ensure that customers only benefit from the 25 megawatts of solar power we're considering here. Using this process will ensure that customers pay no more than they would have had we not entered into the solar transaction, and any downside risk to the customers throughout the 20 years will be underwritten by the companies through this process, and any benefits that are produced will flow directly to the customer. So I only say that as an introductory comment to set up if as I'm going through this, it's not clear that that's what this process does, feel free to interject any questions you have. That will aid in the understanding. So now to what you see on the screen. The example that we're using is actually one of the scenarios that we presented in the original case. It happens to be the one, if you're keeping score, that had a zero cost of carbon, a base fuel forecast, and a 65-year life for our coal units. This case also, as you can see, assumes a REC price of $5 throughout, and so that sets up this scenario. The last introductory comment is this period that we're looking at would be the first 2-year FAC period, and the transaction or the facility would not be operating the full time. So that will become evident as we move forward. So what you see here is what would happen in the monthly FAC proceedings during the first 2 years of the transaction here. And so the solar PPA energy cost, the 1.383 million you see here, is quite simply the price of the solar energy that we've agreed to, which is fixed for the term, times the volume of energy received during that period. The REC sales are similarly $5 a REC times the number of RECs produced during that time period. And these amounts would flow through on a monthly basis the FAC for customer collections of 1.134 million. Next slide, please. All right. So these calculations here will be made at the end of the 2-year period in the 2-year FAC review. And so what we carry over from the previous example is the amount of customer collections, the 1.134 million, but we also pick up a calculation that can be made from our AFB program. And what we are proposing here is that for each hour that we were receiving energy from the 25 megawatts of solar power, we take the cost of the highest priced unit in that hour and multiply it by the volume that we receive from the solar transaction in that hour, and we just accumulate that over the 2-year period. And we're calling that here, for illustrative purposes, the displaced energy cost. And as you can see in this example, once we accumulate those values, the displaced energy cost is $887,000. We compare that to the customer collections, and we have a measure here that we show of the economics, or in this case, the uneconomics for the review period. And that shows that the transaction over this period, reflected in this 2-year FAC review, was $147,000 uneconomic. So next slide, please.
Can we stop there? I have a question, Mr. Miller.
Sure.
So I don't necessarily understand how you calculated 887. So let me ask the 2 ways that I could take the 2 ways I took what you said, the 2 ways that I can understand it. Is the 887 a reflection of the highest unit cost ever allocated to native load throughout the 2-year period times the megawatt hours produced from the solar facility in that 2-year period? Or is it let's just call it avoided cost, the highest unit cost in each hour times the amount of the solar production in those hours, or the highest cost unit allocated to native load times the amount of production from the solar facility in each of those hours accumulated across a 2-year period?
It is the latter, Vice Chair.
Okay, thank you.
All right. So now we've measured the economics or uneconomics of this transaction over the 2-year period. And so,
Let me ask, was there another question?
Mr. Riggs, I was going to ask the same question the Vice Chair asked.
Thank you.
Okay, so we pick up on this slide two more values, and one of those values is reflecting the return to the customers of the $247,000 that were deemed to be the magnitude at which the transaction was uneconomic for the prior period. And we would propose that those amounts be returned to the customer as that transaction was deemed to be uneconomic, thus ensuring that the customer will have paid no more than they would have paid had this 25 megawatts of solar not been available for use. We also pick up here in this illustrative example the cumulative economics, and you will see in subsequent slides here how we plan to use that. Next slide, please.
So can I ask you, Mr. Feller, a technical question? So on this subject, the but-for is effective. You all are, the proposal is effectively a but-for calculation, right? How much the customers don't pay any more than they would have but for the solar. They just effectively pay the price for the solar or the solar, whichever is cheaper for the time period in which the solar is produced. How much with the level of penetration of 25 megawatts of solar, how much energy is actually being displaced from what the company would produce otherwise? Does that question make sense?
Well, let me try an answer and then see if it hits what you're driving at. The maximum we would anticipate would be 25 megawatts in any hour, and it could vary, from anywhere from 1 megawatt, let's say for illustrative purposes, up to 25. Perhaps to help answer the question even more fully, with that small amount of generation availability, the concept is that wouldn't change any unit commitment decisions throughout our process. It's obviously not large enough to do that. We also all appreciate the intermittency of solar, so the dependability of it wouldn't suggest any change to our unit commitment. So what would happen on an hour by hour, or really even more specifically, an instantaneous basis, is that solar would allow us to generate whatever that output is less from all of our other units. But we wouldn't be changing what units are online. It would just be part of that instantaneous dispatch that occurs. And of course, we're talking here about integrating those values over an hour to produce these results. And that's the way our after-the-fact billing program works.
Right, I guess that's what I'm asking. We're not talking about 25 megawatts of a thermal unit, right? That is for getting some sort of UCAP calculation that there's some risk of forced or unforced outage. We're just talking about as available full output, right? Are you all going to be running the system differently with and without the solar? I guess is what I'm asking. Are you all going to be producing the same amount of electricity from thermal units, or are you going to be backing them down 25 megawatts, or is it something in between?
So we would be following load, whatever load is. We would have access to the solar. So in more straightforward terms, whatever the energy available from the solar, we would take that into account. Because the nature of its availability, it is a must-take, take upon availability resource. And then we would dispatch to meet the remaining load. And so thermal units would be moved around in terms of how much energy they are producing based upon how much is available for output of the solar facility. And the AFB program, integrated on an hourly basis, as I previously described, would pick up on that, and we would capture, to go back to the answer to your prior question, we would capture the highest cost unit in that hour that was serving natives load and use that to calculate the economics, the 2-year displaced energy cost as we have it in this table.
Right, but I guess what I'm trying to say is that the AFB process you're describing assumes there is displaced energy, and I guess what I'm asking is, are the companies comfortable saying there is actually displaced energy from the rest of the system, or is the rest of the system going to continue to operate the same as they would without the solar resources?
There would be displaced energy. We would continue to follow load, and at its maximum output, we would have 25 megawatts available from solar to go towards serving that load. So we would back down, if you will, other resources. And again, that's what this displaced energy cost is capturing through AFB, is the economics of that energy that was back down, or those resources that were back down.
I guess what I'm just trying to confirm is, but not necessarily back down by the 25 full megawatts. There's going to have to be some sort of either spinning reserves or whatever it may be, but it's not necessarily on a one-for-one basis, right? So that you have the ability to instantaneously ramp up in the event of some sort of intermittency.
Correct. Within a period, we would still be required to follow load. We would still be required to follow all of our balancing criteria that exists for the system, all the detailed, NERC criteria for meeting load, carrying spinning reserves. You alluded to that aspect of our requirements. So all that would maintain. The difference would be with the solar transaction, we would just have whatever that output is, from 0 to 25 megawatts available. But as you're, I think, articulating here, we would still be obligated to maintain the balance of the system. And what AFB does, given that it's an after the fact, it performs a mathematical stacking, as I'm sure you're aware, of our resources, and can give us a very accurate depiction of what would have occurred, balancing all the things I just described to meet our load requirements. It gives us a very accurate description of what would have occurred, therefore would be an accurate way to calculate the displaced energy cost.
Okay, thank you.
And I guess this is Robert, I would add that on a real-time basis, our system is going to balance sources with load. So as our load changes, our generation system is going to change. And all that's going to be balanced according to the criteria that we have for spinning reserve, for maintaining frequency. So in real time, all that's going to balance with the system that we have. AFB is just after the fact. It takes what originally or actually occurred, back it from the lowest cost to the highest cost. And then that highest cost is what we're saying is displaced by the solar.
Yeah, and I guess what I'm really asking here is, the companies have said that this size solar will help them understand how to integrate renewables, right? And I understand that from the perspective of actually running the system. I guess what I'm trying to understand is how do you determine, ignoring just the raw economics on paper, how do you determine the economics in practice of the integration of renewables of this size and of larger size if you're just running the system based off the, economically constrained, security constrained economic dispatch of your system, doing what you need to keep the lights on, following load, and then just assigning, using the AFB, assigning things accordingly. How it's one thing to use this to integrate or learn how to integrate renewables. I I guess what I'm trying to get is, since the AFB is literally an after the fact, it's not even an analysis, it's just a after the fact allocation of costs. How do you determine whether there are additional costs that arise from trying to integrate the renewables by using the AFB, or is there another process by which, if this whole thing is approved, that you all are going to determine what the actual cost of integration and the impact of integration of renewables are, moving forward when you're determining whether to add additional amounts?
Okay, so let me take a shot. I think the root of your question goes back to a concept of how much solar are you trying to integrate. With this 25 megawatts, it is so very small in compared to any system load that we experience throughout the year that, as I had stated earlier, we would not change any commitment. Any way we operate the system would not change. Now, I heard in your question that you just asked, what would happen if there were other costs to integrating solar, if there were other impacts to being able to balance load with generation given the intermittency of solar. Those costs would have to be evaluated when we get to the point that there would be enough solar on our system that we would be altering the dispatch of our units, that we would otherwise look to change commitments, that we would otherwise perhaps change the way we maintain our units, when we take units off for maintenance, and so on and so forth. We would be way far from that. So I think you said it, we would look as we got into a much greater penetration of solar than what we're contemplating here. We would have to consider those aspects of the impacts to operating our system. If you think, for example, I think I've done a calculation before, roughly 5% of our system energy, if we were to try to produce that with solar, we would need 700 to 800 megawatts of solar. Once you get in that broad time frame, one could appreciate that you would be changing some of the more fundamental ways you commit your units, you look to serve load, than of course in this 25. So I think as an answer to your question, I would say as we add increments of solar well beyond this 25, we would have to make those considerations as you're suggesting. Are there other impacts to the system in integrating those levels of generation? But definitely for 25, very similar to the 10 megawatts we have at our Brown solar facility and have operated for quite some time, those levels of generation wouldn't require any other cost. The cost of integration or the savings of integration, however you want to look at it, would just be the up and down amount of generation that you have to alter so that you continue to match your load with your generation.
Yeah, so I guess, it's 100 megawatts. I guess what I'm trying to get to is Mr. Sinclair said that the 100 megawatts of nameplate solar adding the 100 megawatts of nameplate solar to the company's system will allow the company to gain additional experience in the integration of large solar facilities into the existing generation and transmission system. And I'm just trying to find out, as it relates to the cost incurred and the cost recovered, is there anything we're going to be learning from the finances or the costs of this that is useful moving forward at all? Because I guess what I heard from your answer, and I guess what I'm kind of concerned about is, it doesn't seem like you all, it seems like your answer about 700 or 800 megawatts is, when you look at adding that many, then you'll start trying to figure out what the cost would be, right? But if you're looking right now to add 100 megawatts, I guess I don't understand how you all are planning to study the 100 megawatts so that it's helpful in gaining additional experience. I'm just trying to figure it out. If you all are going to run everything the exact same, that's fine. I just took away from the previous testimony that there were going to be things you were planning on learning. And if just using the AFB to allocate costs after the fact, I just don't see that I don't see that you're necessarily going to be gaining much from the finances and the cost of the experience on the finances and the cost of the 100 megawatts. So I was just trying to clarify whether there's anything that you all expect to learn using the actual economics of it, and if you can gather that from the AFB or if you're going to have to look at it differently.
Sure. So I think I get the question you're asking. And we would look at if we're talking about the full 100 megawatts, we would look at its variability and how our units are able to respond to that. So I think we would have some learnings there. The other thing that it would produce is a significant amount of data that we could analyze, what I would say offline, not as part of the day-to-day operation, but it would produce that data that we could take and look at, well, what if that was 200 megawatts? What if that were 300 megawatts? Or in my example, 700 or 800 megawatts? So we will have that learning. We obviously can do a bit of that with our 10 megawatt solar, because as I think everyone appreciates, these solar farms are just based on solar irradiance that we have and the variability and how many panels you have. So we would be able to do those things, but and we would also understand on a transmission, I think you brought that up, Vice Chair, what that means to the loads on our system. We've obviously studied that, or will study that, and don't see that as being an integration issue. But real-life experience under a variety of conditions will be useful. But you are correct in drawing the distinction between the way we've analyzed this in terms of the hourly data that we've accumulated and provided results to the Commission. We are assuming in that it doesn't have a change on unit commitment. But that doesn't mean that we won't take that data and try to extrapolate it once we get some real-time experience and say, well, what if that, were multiple hundreds of megawatts and not just the 100 that we're seeing? Hopefully that helps answer your question.
It does. So, and the last one I have, is 100 megawatts large enough to change your unit commitment?
Given the variability that we see with our 10 megawatt solar and would expect to see, with this solar farm, we wouldn't be changing our unit commitment. Our lowest load is in the thousands of megawatts, so it wouldn't change our unit commitment. And I think most appreciate the nature of solar. You can have a sunny day with a few clouds and see extreme variability, so that would add to unit commitments. If you were to ask me, from what I know about solar, Vice Chair, when you could get multiple large solar facilities with geographic diversity, where you have more dependability, one cloud coming over a geographical area or a solar field wouldn't necessarily drive your solar output to a very low level, then you might consider looking at unit commitment changes if that's helpful to illustrate the point.
Okay. Thanks.
Okay, back displaying, Robert. I don't see it. Does everybody?
Yes, I can see.
Oh, you can see it? Okay. I'm not seeing the exhibit. Is everybody else seeing it?
It's on the screen here.
Yes.
That's showing on mine.
I'm going to reload it.
Yeah, my screen sharing icon is spinning.
Okay. Now it's up. Is it up, Allison?
Yes.
Okay. Mr. Cook, can you see it? Okay. I saw your lips move, so.
Yes, that's correct.
All right. So now back to the example. And so we fast forwarded through another 2-year period where we have the solar operating, as I had mentioned earlier, for the full 2 years. So you can see the solar PPA energy cost being reflected here as $3.114 million. We sell RECs again at $5 a REC. for a benefit of $560,000, and then we would have collected, in this example, $2.554 million from customers. We again do the calculation that we've been discussing to calculate the displaced energy costs on an hourly basis, accumulate those calculations, and we come up with, in this period, having the 25 megawatts available, benefited customers to the tune of $2.66 million. So over that period, it was a net benefit to customers of $106,000. And so the proposal here would be very similarly to the prior column, the prior slides that we went through. In this case, we would, instead of returning money to the customer, we would collect that benefit from the customer, having kept the cumulative economic value in the previous 2-year period of $247,000. But I would note, we would only propose to collect the amount by which the transaction was beneficial to customers during that respective 2-year period, in this case, $106,000. Once we would collect those values, then we would modify the cumulative economics to reflect that, and that cumulative economic value would go from $247,000 negative to $141,000 negative, and then that value will be available for the next 2-year period on which to judge the cumulative economics of the transaction. The next slide, Robert, or? Okay. Next slide. Okay, now, okay. All right, so fast forward again, we picked up a November 24 to October 26 period, and the solar PPA cost, very similar to the same, $3.147 million. The REC sales revenue, very similar to the same, because we're pricing it at $5, $566,000, and customer collections in that period would be $2.582 million. The 2-year displaced energy cost, again, results in a benefit to the customer. The displaced energy cost is $2.853 million. The net benefit of that period is $271,000. But once again, we would only collect the amount that is reflected in the cumulative economics column, the $141,000. Again, ensuring that in this period, the customers would have paid no more on a cumulative basis than they would have paid had we not entered into the transaction. And actually, at this point, the cumulative economics reflect that by October 2026, using this as a specific example, the customers have now benefited to the tune of $130,000 by having access to the 25 megawatts of solar. Fast forward to the next slide, please. And what we're doing here is just following it out for another period so that it further illustrates that once the cumulative economics value becomes positive, we would be letting all the value flow to the customer in those 2-year periods, and there would be no collection or obviously no refund to customers. So at this point, we've accumulated value for customers of $486,000 by having entered into the transaction. And then I think we have one more illustrative 2-year period. And so now you can see that the transaction continues to be beneficial to the customers for the 25 megawatt portion. And we end up here reflecting a cumulative economics of $951,000 that we've accumulated to this point. And this example, just for to kind of tie out this example, as many know, in the case we have reflected net present value of benefits to customers. If you were to follow this transaction out for 20 years, this case would predict approximately $2.1 million of net present value benefit for the customers, at the same time ensuring that within these 2-year windows, as we walk through successive FAC proceedings, the customer would pay no more than they would have paid had we not entered this transaction. And then we have one other example just illustrated, if we could go down one more slide, that just shows the full example. And this is an example where zeroed out the REC prices, which is highly unlikely. If you look at REC prices today, they're trading between $9 and $10, the Ohio REC prices that the market we typically sell into. So zero is a very probability event, but following through the same logic, if REC prices were unavailable to us, in this example, the customer would be underwritten, the customer risk of paying more than they would have paid otherwise would be underwritten by the companies to the tune of the values you see in the period returned and collected column there. So this is just an example to show that we would never collect any more through this process than we would have had we not entered into the transaction. More of a extreme case. So hopefully that helps with the concept, and I know there's other testimony that describes exactly how we would propose it to work on a monthly basis, but I wanted to stick to more of the concept to see if there were questions on that or there were concerns that the way this is structured, we wouldn't be accomplishing what the commission had put forth in the order, and that is to ensure that customers pay no more than they would pay had we not entered into this transaction. And they benefit when that is possible through the transaction value.
Mr. Beller, Mr. Conroy, and Mr. Garrett are available for any further questions.
Yes.
All right, at this time, normally we would permit the Attorney General's office to ask questions on cross-examination first, but in this case, staff counsel has asked for permission to question witnesses first. So at this time, Ms. Vincent, if you have questions?
I do have a few questions. Thank you, Chairman. I will let the parties know I will have some questions we'll have to go into confidential session for, but what I prefer to do is take care of the questions in the public session first. And good morning, Mr. Beller, Mr. Conroy, and Mr. Garrett.
Good morning.
Good morning.
Mr. Beller, I want to build on something that you just discussed about the net present value. In David Sinclair's testimony, he indicated that there was a potential for the annual fuel expenses to slightly increase through the early 2030s, so roughly 10-year period, at which point the solar PPA would likely result in energy less expensive than coal or natural gas, which leads staff to ask, as a post-hearing data request, if LG&E KU could provide a copy of the expected costs, the fuel expenses, for each year of the PPA. And
The fuel expenses that, well, let me ask to be specific. The fuel expenses that we would expect the PPA to offset, or another fuel expense value that you're interested in?
well, I think the fuel expense that underlay Mr. Sinclair's statement, basically that there would be a slight increase in annual fuel expense through the early 2030s. Would you like a reference to where in the record this is? And I will include this in the post-hearing data request.
I see a reference on page 3 of 44 from David Sinclair's testimony, Exhibit 2.
Yes, that's correct.
Yes, we can provide that value. It may already be in the record. If it is, we can point that out. I know there's a tremendous number of exhibits and attachments within the record. That that data may already be there, but we can ensure that we pull that out in a way that's straightforward in response to your question.
Thank you, Mr.
As simple
Butler.
as Robert, I would you could look at its confidential attachment to PSC question 2-1C. That may be what you're looking for, but if it's not, then we could provide it post-hearing.
Okay, why don't we do this tentatively? Staff will review the response to 2-1C, and after the hearing, let the parties know whether or not we'll go forward with a post-hearing data request for this question. Is that acceptable?
Yes.
Okay. Thank you. For the next questions, we'll need to go into confidential session.
Okay, let's,
Before we do that, Ms. Menzel, can I ask an additional on that exact subject?
sure, go ahead.
Is there anywhere in the record, I know that Mr. Sinclair provided a matrix with what he believed to be the net present value revenue requirement impact of a number of scenarios, right, in today's dollars. Well, not nominal dollars, but so is there anywhere in the record where the annual calculations that underlie those net present value amounts are?
Yes. Robert is looking for the exhibit, but
I believe it is the data response that I mentioned earlier. PSC 2-1.
It has the explanation of the scenario and then the economics of it each year of the 20-year period?
Yes, it does. If you look at Sinclair's testimony, table 2, I believe that's the matrix you're talking about. Is that correct?
I'm doing it from memory, so I can't.
I think it is on page 17 of his testimony. That has the present value revenue. It's a confidential table, so won't quote anything. It has all the numbers for all the scenarios for different rec prices. The attachment to PSC 2-1C is the annual information that ties to that table.
If it would be helpful, I've got that information I can pull up and share, but it is confidential.
Okay, we can finish the discussion on the confidential session. That's fine. I just your question, Ms. Vincent, prompted that, so we can wait. Thank you.
Do we need to go into confidential session now?
Yes, Chairman, we do.
Ms. Sam?
Yes, sir, you're there.
Okay, we are now back on the record in public session. Ms. Vincent?
Thank you. I just have one more question, Chairman. Can you confirm that LG&E and KU both intend to file rate cases on or after November 25th, 2020?
Yes, the company filed their notice of intent this past Friday for filing a base rate case on or after November 25th, based upon a forecasted test year ending June of 2022.
And are there any plans to include in base rates the costs for the portion of the solar PPA that will be used to serve native load?
The cost associated with the energy to serve native load is set to go through the FAC completely, along with the REC revenues as well. So no, there would not be anything associated with the PPA and base rates.
Thank you. Staff has no further questions at this time.
Mr. Horn, Mr. Cook, any questions?
No questions, Mr. Chairman.
Thank you. Vice Chairman, any questions on your behalf?
I do have a couple, Chairman. Can you hear me okay?
Yes.
Yes.
Thank you. So my questions are, I guess, are clarifying so that I fully understand what's going on here. Where we are, where we started. So, in the application, as I understand it, the proposal was for the commission to approve the PPA and the recovery to occur through the FAC, where the AFB would assume that the solar cost was $0 and put at the bottom of the stack, always allocated to native load. Is that correct?
For AFB purposes, when putting it at the bottom of the stack, it's assumed a zero cost for AFB purposes, but the actual cost of the PPA energy would look as they see through that process as well. But yes, it would, in the application, it was stacked at the bottom of the stack and allocated to native load.
But, so is what I said correct, I guess? Is my understanding of it correct?
I believe so, based on what I interpret you said.
Okay, so...
Mr. Vice Chairman, can you repeat what you said, please?
Yeah, the cost and the proposal, the application, was for the commission to approve the PPA, just approve it. The cost of the PPA will be recovered through the FAC, and the actual PPA will be put at the bottom of the supply stack, or the 25 megawatts allocated to native load. I don't know about the other 75, but as I understood, the 25 megawatts be put at the bottom of the supply stack in AFB and assumed has zero variable cost for AFB purposes, and be allocated, because it's at the very bottom, would be allocated to native load.
That is correct.
Okay, so is that for the 25 or the full 100?
That would be for the full 100 megawatts. Dow and Toyota would pay for the energy costs associated with the 100. So actually all customers get the benefit of that 75 megawatts being at the bottom of the stack and determining the average FAC cost.
Okay. So we'll get to the other part of that question in a second. Okay, so can one of the witnesses explain what they believe to be what the commission ordered, at least as a what the company's assumption was of the commission's order as to the cost recovery of the 25% of the PPA allocated native load of the May 8th order?
So, my interpretation was that the commission wanted to use the actual economics of the transaction as judged, for example, in a 2-year FAC. I think the commission left it open that they may choose to look at periods even shorter than that, but that was my interpretation of the order versus what the proposal was in the application, and that is the approval be provided for the 20-year term of the transaction, and as Robert just described, the treatment would have flown from that approval as he described. But I understood the commission to say that there needs to be an economic evaluation done, and for discussion purposes here, over a 2-year FAC period, which is what the example that I just went through.
Okay, so Mr. Bellart, we
Follow up on that. I mean, the other criteria in the order was that it was the economics of determined based upon running AFB with and without the renewable, which, as we explained, AFB is not a production cost model and can't be run with and without.
Okay, so is it the company's impression that what the commission ordered, at least in concept, is what the company is now proposing without the 20-year netting? That each 2-year period be looked at in isolation?
That was our concern, that that is the way it would be administered, the reviews would be administered. That's part of why we asked for a rehearing, to have a discussion around the proposal that we made that meets what we think the objectives were in the order, but also allows the company to be judged on its quality of decision, if you will, over the 20-year period, not shorter 2-year periods, given that it's a 20-year transaction that the companies are into, not a series of 2-year transactions.
Okay, but I just want to make sure that what I'm trying to figure out is we're on the same page or not. So when you all read the order, you were under the impression that effectively what you're proposing now, Mr. Bellar, with the net of REC, net of what is effectively, by your all's, I think your all's quote is that it's effectively the avoided energy cost, a calculated avoided energy cost, that the economics of that netted, the hourly economics netted against each other over a 2-year period is what the commission ordered in the May 8th, and your all's proposal is to take the economics over that 2-year period and instead net them against subsequent 2-year periods over the entire 20-year term of the PPA.
So to parse that question out, just to be clear, the reason we wanted to petition for rehearing or have a discussion on this issue, if you will, is we were concerned that each 2-year period would be judged in isolation. And so we developed a proposal that we went through, and so what we are proposing, that our proposal would ensure the Commission's objective, and that is that the economics of this transaction, actual economics, will be calculated, and for discussion purposes here, let's assume 2-year FAC period. And then in subsequent periods, there would be a look back to the extent that that transaction was beneficial, and if there had been money refunded to the customers in prior periods, that would be considered in the recovery allowed in that period.
No, I understand. I understand the proposal now. I'm trying to make sure that we were on the same page as of May the 8th about what the May 8 order said.
So that we interpreted the May 8 order that from that it was possible or likely that the Commission would look at 2-year increments, evaluate the 20-year transaction on 2-year increments, and whatever the economics were in those 2 years, that adjustment would be made to recovery, and then the second 2-year period would be judged in isolation. That was our concern. It wasn't, I wouldn't say it was 100% clear, but because we didn't talk about how all this would work in excruciating detail, but that was our concern. And if the companies were going to underwrite the risk that this transaction would, over the 20-year period, be uneconomic, we wanted to make sure that it was judged that way and not judged only on 2-year periods. But we appreciate what the Commission is saying, that over those periods, we don't want the Commission doesn't want the customer to pay more than they would have, and so that factored into how we came up with our proposal.
Right, and in terms of calculation, I just want to make sure that I understand your all's proposal here, at least as it is, forget the last 18 years, but at least within the calculation of the 2-year period, your all's proposal is intended to reflect the Commission's order on May the 8th, in that the energy under the PPA net of REC sales is not more expensive than the energy that is displacing, right?
Correct. For that 2-year period, that's what our understanding of the Commission. Excuse me. Go ahead.
Each hour is what I'm really trying to get to. Each hour that calculation is done.
Correct. And accumulated over the period as we've been discussing here.
Right. Okay. So that's why. Okay. So that's. I'm trying to make sure that at least on May the 8th, we have we're all on the same page about where the company was, right, or where the Commission was and the company perceived it. So, and this is a question for any of the three witnesses. If today, well, no, let's take a step back. So on petition for rehearing, the company, so even going further back, during the processing of the case, you all would agree that the company's proposal of running this PPA through the FAC was that the PPA was akin to economy energy purchases that the utility already does, right? That's why it makes sense to recover through the FAC.
I would say yes to that, but additional factors. The main factor would be that the economic analysis included all the different scenarios supported that the transaction in all scenarios would be beneficial to customers. In addition to that, correct.
Yeah.
Correct.
Okay, so in the petition for rehearing, the company discussed the determination of economy versus non-economy energy purchases as historically applied for the last, let's just say, 2 decades, right? And the discussion was around an early 2000s case. And so this is directly from page 3 of the company's petition for rehearing. That the 2002 commission order, this is the quote, it defined economy energy purchases that are recoverable through an electric utility's FAC as, this is quoting the order, purchases that an electric utility makes to serve native load that displaces its higher cost of generation, and that have an energy cost less than the avoided variable generation cost of the utility's highest cost generating unit available to serve native load during that FAC expense month. Okay, so let's just talk about, forget the PPA for a second, or, forget the proposal. Does the company read that 2002, or let's just say the current FAC review for economy versus non-economy energy purchases, to be a calculation or determination, forgetting direct sales, similar to what is proposed by the company right now, which is the highest unit allocated to native load, or is it the highest unit available to serve native load?
That language goes back to the 2002 cases. It is the highest cost unit that is available to be dispatched in that expense month. Whether it did get dispatched or not, that is different than what we're proposing here.
Yep.
What we're proposing here is to use actual dispatch stacking from AFP.
Okay, that is, thank you very much, Mr. Conroy. So hypothetical, the companies go out in 1 hour and purchase electricity at 100 megawatts, right, at $45, right? So $45 a megawatt hour, right? Its highest dispatch unit was $24, and its highest available unit was $30, available to serve native load, right? Under the definition, that would be a non-economy energy purchase, right?
That would be a non-economy energy purchase, and we could recover up to the cost of the highest cost unit, the $30 that you're saying.
Okay, so the company would effectively not be able to recover the $15 increment between the $30 of the highest unit available and the amount paid for the off-system purchase, correct?
For the FAC, correct.
Right, and then even through the AFB, even though the $24 was the highest unit allocated to native load, it's immaterial under that 2002 case.
That's correct.
And that's done on an hourly basis through 8,760 hours a year.
That's correct.
Except for people who are running, except for the leap year. Yeah. So $8,760 and a quarter on average. Okay, so that is done on an hourly basis currently. So insofar as the current process is looking at everything on an hour-for-hour basis, that even if, let's just say hypothetically, in the next hour, Mr. Conroy, in our hypothetical, even though you bought $45 of energy netted against 30 of the highest, your highest unit was $30, if you bought $45 in that 1 hour, and the next hour you bought electricity or energy for $5 a megawatt hour, and your highest unit was 30, and your highest unit dispatched to serve native load was 24, that entire hour of the $5 purchase is immaterial as it relates to the previous hour, right? You don't get to net those 2 hours and recover the incremental $15, right?
That is correct.
Okay. So the commission's order, instead of looking at it, the May 8th order, instead of looking at it on an hourly basis, the commission's order allowed the utility to look at it over 17,520 hours, right? That netting the positives and the negatives of each hour increment against each other over the entire 2-year period, correct?
Yeah, I would say the difference, though, is you're only entering into a 1-hour contract and an obligation there. What we're doing here with this PPA is we're signing up for a 20-year contract based upon the economic valuation that we believe it was economic over the entire period. We acknowledge that it may not be economic in every hour in the early years, but it was in the later years, such that over the 20-year period, it was an economic transaction. That's different than what you're talking about with an hour by hour, where we're only entering into an obligation for 1 hour at a time.
Right. But the company's proposal was that this is non-capacity, pure economy energy, right?
That's correct.
Okay, so and again, I'm just trying to do this to get on the same page. We can agree that what the company was referring to as economy energy was more of a generic term and not the technical term of the FAC.
Can you say that again?
Yeah, when the company in this case has been talking about economy energy, it was using the term generically to talk about the economics over a 20-year period and not the specific term of the FAC. Because that's a defined term, right?
I believe there is a defined term of what's economic and what's not economic for the FAC purpose.
Okay. All right. So on rehearing, what was the company's proposal?
The company's proposal was that it could not do a before and after scenario,
Okay.
and that the defined methodology for determining economics using the highest cost unit available to be dispatched that's been used for many years could be used for this purpose to determine economics.
Okay. And so on page 6 of the petition for hearing, it says, in sum, the highest cost unit calculation approach provides a readily available commission-approved and familiar basis of comparison for determining the cost-effectiveness of the portion of the PPA allocated to all customers. The order should be clarified to use this standard of review of the native load segment of the PPA in the FAC biennial reviews. So going back to what Mr. Bellar was talking about, his takeaway from the Commission's May 8th order, was it the company's position that instead of running the calculation that effectively the company is proposing here, isolated to 2 years, against the highest unit allocated to native load, that instead the commission should look at it in isolation for 2 years to calculate the PPA net of rec sales in each hour against the highest unit available to serve native load per the 2002 economy, non-economy distinction.
Okay, you've got a lot of things within that statement, so I'm not.
Would you like me to break it out, Mr. Conroy?
Why don't you break it out?
I'd be happy to. Sorry. My brain works in very different.
I would say what we proposed in, what we recommended in rehearing was the methodology established using the highest cost unit.
Okay,
Based on
but
the order after that, we reconsidered and thought of different ways in which we could determine the economics. And to help satisfy the Commission's order from May 8th and try to accomplish what we need to keep customers no worse off and still give us the ability to enter into this 20-year contract with some assurance that it would not be one-sided.
yeah, no, and I'm just trying to make sure that I fully understand the implications of particularly what was raised and what the commission granted on rehearing, which the company proposed that the company, well, let me ask it this way. Was the company proposing the hourly FAC review of non-economic versus economic energy that the commission currently undertakes for those 1 hour purchases?
As we stated in the rehearing request, we were proposing to use that methodology applied to the BPA on an hour-by-hour basis.
Well, but I want to make sure that's clear. That each hour is looked at independently, or being able to net the economics of each one of those hours over the 2 year period?
With the methodology of the highest cost unit, it's not done on an hour-by-hour basis. It looks at the PPA is a single price for any energy that is purchased, and it's compared to the highest cost unit that was available for the entire month. And that's different than using AFB and the highest cost unit in the stack on an hour-by-hour basis. Given that
that's different than. Go ahead.
Given that this hour contract is a fixed price, flat energy price for all energy received, you're comparing one number to one number for the entire month.
So that's why I wanted to make sure that we were on the same page about what the current FAC review is about. Are you saying that it's not an hourly look, or it's an hourly look, but the highest unit cost is the monthly highest unit cost and not the hourly highest unit cost?
That's correct. It's the highest unit that is available to be dispatched for the entire month. So if there's a unit that's available for the month, that's the price that's used for any hour to compare to an economic purchase. And those economic purchases could be, as you mentioned, it could be $100 1 hour. It could be $50 the next day. It could vary depending upon the hours in which we actually purchased it for that economic comparison.
Okay, so I just want to be clear. The proposal on rehearing was that the utility be able to take the amount of the rec in each hour and compare it to that entire month. I guess I'm confused about how we went from an hour to hour review, the economy versus not economy under the FAC, back to an hour to hour review, but over a 20-year period. I'm trying to understand exactly what the company was proposing as it relates to the petition for rehearing, to determine what the commission has to determine what the appropriate FAC review is, right? I'm trying to figure out the exact calculation. Is it a overall 2-year period? Is it a 6-month review? Is it a 1-year review on the petition for rehearing? So can somebody at the company walk me through what the petition for rehearing was, what the proposal was as it relates to the PPA's economics?
So, Vice Chair, what we would have proposed, let's just take you through how I would see it working, is that we would have entered into the transaction. That transaction value, let's use numbers to help illustrate the point, is $27.82. We would accumulate for a month the values of energy that we received, and we would propose to collect from the FAC that $27.82 for every megawatt hour we received in that month, net of any REC sales that we made in that month. We would propose to collect that from the customer to the extent that that average megawatt hour value produced by that calculation, so it would effectively be $27.82 minus the average value of the RECs we sold, right? So let's say the RECs were $7.82 to make it simple. So the net cost was $20 a megawatt hour of that transaction. Now in this case, it's the same for every hour. So we assume that $20 would be recoverable by comparing it to the highest cost available to be dispatched during that month. Let's say that was a $75 a megawatt hour unit. We would specifically do it for each utility, LG&E and KU. And we would, by that calculation, be able to collect the $20 a megawatt hour. So it would be an hourly look at determining what the cost of the solar transaction was. In this case, hourly or cumulatively gives you the same answer because it's the same price. And then we would compare that to one value, and that's the highest cost unit for that month. And then to further maybe help where you're at, the way I'm seeing the flow of things is the commission, in their response to our motion for rehearing, made it clear that they wanted us to consider the, quote, actual economics of the transaction, which that process doesn't necessarily do that based on the emphasis the commission provided in their response to our motion for rehearing. And then that led us to develop the proposal that we've discussed today. I don't know if that's helpful at all.
No,
but that's actually transparent.
And so,
Mr. Vice Chairman, I think one of the figures Mr. Belli answered is a confidential figure.
No,
It's not?
all right, 2782.
Excuse me, please
I
proceed.
think there's a May 8th order that addresses that that very specific number. So okay, that is extremely helpful. So it's economic insofar as in each hour, and we know it's the same amount each hour. That's the benefit of a levelized cost of energy contract, right? In each hour, assuming that the RECs, do we average the RECs over the entire month to net?
We would propose to do that in any evaluation. The RECs, as you probably appreciate, there's a process for them to be verified that they were created. It's roughly a 4-month process that it takes. There's a different accounting treatment that Mr. Garrett can explain, but the actual RECs themselves are typically entered in by the creator, in this case IBB, on a monthly basis. And we would tend to sell them in lots that would suggest averaging. We wouldn't be selling in small enough lots that you would suggest anything less than a monthly accumulation of that value and averaging.
Okay, and the second part of that is, assuming that they're on average, would you have the figures available for the actual REC sales for each FAC review? Would you have it in time?
Are you asking about a monthly review or a longer period?
6 months or a 2-year?
Mr. Garrett, maybe it would be helpful for the Vice Chair if you, I don't want to go into too much detail, but explain how we would manage the REC cost on a monthly basis and then subsequently on a 6-month basis.
Sure. I think it's best to try to understand the accounting for how to account for rec sales. And really, you first must start with the solar energy payment represents really two components. It's both the solar output and the RECs themselves. And so the company will allocate a portion of the solar energy payment to the REC and a portion of the solar energy payment to the output. The REC accounting will actually result in an inventory accrual. So each month, when the company makes a solar energy payment, a portion of that payment will be recorded to inventory, with the output recorded to purchase power expense. And so customers will actually receive the benefit up front because the only thing that will flow through the FAC is the purchase power expense. Now, as I mentioned, the REC is recorded to inventory. And once we go through the 4-month period of certification and that REC is sold, what will occur is the company will record REC revenue with an offsetting purchase power expense. There may be a true-up because the amount that we allocated to the inventory value was based on the market value at the time of the energy payment. I would expect that we would update that market value on a monthly basis, depending on how variable, how much fluctuation there is in REC prices. But really what I want to point to is that customers will receive the value of the REC up front and not have to wait the 4 months because they will not pay through the FAC. They will receive the value of the REC because the only thing that's going through the FAC is the purchase power expense.
So you would effectively, when you book it to inventory, you're doing it on a mark-to-market basis effectively, and then on the assumption on prevailing market prices, whether the actual, when you do sell them, whether the actual price is different will get trued up through the 6-month or 2-year FAC.
That is correct. It will flow through our accounting. We will adjust the REC revenue, and that will flow through on a monthly basis.
Okay, so thank you, Mr. Garrett. So going back, assuming we know with some reasonable certainty, since it's a fairly liquid REC market, you can, on a monthly basis, say this is our levelized cost of purchase. We know what it is, right? Net of an average of what we know the megawatt hours consumed, so we know how many RECs we're going to get, right? Because we know how many we purchased. The average REC price over that period times the number of RECs, or the market price times the number of RECs over that time period. And let's just make up that number. Let's say it's $20 is that net amount, right? And then let's say that for some reason the highest unit cost available during that hour was $19, or during that month was $19, the highest unit available. Then those would be non-economy energy purchases under the scenario and the proposal laid out in the petition for rehearing.
If those were the facts, correct, and we would be able to collect $19 if that indeed was the highest unit available on our system for that month to dispatch. Yes, in that hypothetical, we would collect $19 instead of the $20.
Sorry. Okay. So two things. The first is let's just make up a scenario that the companies have a 13 megawatt simple cycle CT that is available and it costs $50 a megawatt hour to operate. Does that net against 13 megawatts of it, or is the fact does the amount of the highest unit cost? Let's just say it this way. Say you have a 13 megawatt simple cycle CT that costs $45, and you have you have two of them, right? 26, right? And you only have the 25 megawatts of the max output of the solar facility allocated to native load, right? Is there any difference between that scenario for purposes under this proposal and one in which you only have one 13 megawatt simple cycle CT that costs $25 or $45 for calculating economy versus non-economy purchases? Does the entire, I guess what I'm really asking is, does the entirety of the purchase, the economy purchase, economy or non-economy purchase, have to equal or be less than the highest unit cost used in the calculation?
Let me attempt. You had a lot of things in there again. Let me just go back to the non-economy and economy methodology that was established back in the early 2000 time period that's been used ever since for economic versus non-economic. That process looks at the highest cost unit that is available to be dispatched for the month. If it is available to be dispatched, that is the price that is used to compare for economic versus non-economic. It doesn't take into consideration what size it is or how much is actually purchased. Any purchase power that is greater than that highest cost is excluded up to that highest cost unit. So that's the process that's been used since early 2000 time period. That's not what we're proposing in the rehearing.
That's fine.
We're using actual, based upon the Commission's order on rehearing, we're using actual data from AFB, the actual highest cost that was allocated to native load in any hour compared to the solar PPA net price.
And let me add one thing to that in terms of context. If I recall back in the 2002 time period, the purpose of marking the highest cost unit available for dispatch in a particular month was to put some reasoned value to what would represent an economic purchase. Many who have been around a while will appreciate that prior to that time period, there had been multi-$1,000 a megawatt hour transactions in the marketplace. And so I think one has to keep that in context, that the idea of establishing a reasonable marker on a monthly basis wasn't taken to the level of trying to match megawatts, which I understand your question, Vice Chair. But I think in order to appreciate why that decision was made, one has to appreciate the environment in which we were living in during that time period. Not to say things can't change, but that's where we came to in that situation, is what is a reasonable marker that would represent an economic purchase that the companies would enter into, and the point that's been made, could be 1 hour or multiple hours.
Do any of you all offhand know within 10 megawatts, 5 megawatts, what the high unit cost is in any given month?
It's going to be different by company. For KU, the highest cost unit price is in the $60 to $70 range, depending upon gas prices. For LG&E, I believe right now it's in the $40 range. Those numbers and figures are provided in our monthly FAC filing.
Right. So let me ask it this way. And this is a question for any of the three of you again. What is the likelihood that, let's just say it, $28, right? That if the company made off-system purchases at $28 in each and every hour of the year, it's a minimal amount, like this, not a lot, but just a minimal amount, each and every hour of a 2-year period. Is there a significant likelihood, and if so, how many, I'm just saying approximately, is there a significant likelihood that under the 2002 FAC that they would ever be deemed non-economy?
No, not under the approach that Robert just outlined. Those costs would vary, as Robert described, between KU and LG&E, but given reasonable, expected fuel prices, a $28 transaction would be deemed to be economic during that time period.
And you all have an expectation that in the response to 2-1C, you all provided the year-by-year economics under the different scenarios that summed and I guess discounted come out to be the net present value that were included in Mr. Sinclair's confidential matrix. And if it's not, I guess what I would ask is, if that's not what it is and we go look at it, you all can provide that, right?
Correct.
Yeah, if I'm interpreting what you're looking for, I believe that attachment has the annual numbers that would equate to the net present value that's in those tables.
And the other thing that I would ask is, has the companies performed an analysis for the different scenarios that Mr. Bellar referenced today for the, and correct me if I'm wrong, Mr. Bellar, the base case $5 rec, base case fuel $5 rec, and 65-year retirement. Have you all done that analysis under your current proposal for all those scenarios that Mr. Sinclair laid out in his matrix?
The matrix that Mr. Sinclair produced had values of rec prices of 0, 2, 4, and 6. The example we chose was a $5 rec price. We could provide that same detail for the $5 rec price. It would quite simply be an interpolation between the 4 and the 6, but we can provide that annual detail for you with respect to that. But the exhibit that Mr. Conroy's been referring to would not contain that precise scenario because of the rec price assumptions made in that. But we can most definitely add a $5 rec price to that.
Yeah, the other way around, I guess is what I'm asking. Would you be able to do the calculation, the analysis that you showed today for those different scenarios that
Correct. Yes, we could. We could show the 2-year FAC period and the respective treatment that we're requesting for those periods for any and all of the scenarios, if that's something the commission wants to see.
Yeah, and I think we would. And what I would say is that would show us absolute under Mr. Sinclair's analysis when it turns positive as compared to those scenarios, but it would also show us when it turns positive under the scenario, under the proposal that the companies are making.
Correct. Those would be broken up into 2-year increments. I know we've looked at that internally as we were thinking of different ways to respond to the Commission's response to our motion for rehearing, but we can most definitely make the calculations consistent with the example I went through today for each of the, I think there's 48 scenarios, and we can show that, and then we can do that in the 2-year blocks, and you will see what you're looking for there, I believe.
So each of those scenarios, the rec prices were flat for the entire 20-year period.
Okay. Those are the, those are all the questions I have, Chairman. Thank you.
Commissioner Matthews, questions?
I think the vice chairman covered mine, but if you noticed, I got beeped out and got back in. And I think in the middle of when he was asking the questions about the switch between the 2-year and the 20-year, why the proposal is now the 20 years when I guess one could interpret what we asked for was a 2-year, correct?
Correct.
And I guess I was kind of wanting to just ask the question of what are the benefits to the customer of that 2-year versus 20-year, and what's the benefit to the companies for that 2-year versus 20-year?
Okay, so let me start with the company. The company envisioned entering into the transaction based on an analysis for the full 20 years, appreciating that under certain scenarios in short periods than 20 years, it could be uneconomic for the customer, but as many things that we evaluate, we looked at the decision in front of us was a 20-year transaction. So the benefit of not breaking it up in 2 years is to be consistent with that evaluation. And it would also recognize in our proposal that the company obviously is not earning a return on this transaction. It's just proposed as a pass-through. And our proposal would be, again, ensuring that the customers have really a perfect hedge against rising fuel prices on our units. And so that's the benefit to the company, so that on these shorter periods, the company wouldn't have to absorb costs while delivering benefits in future periods, that we would look at it consistent with the evaluation that we made. Is that helpful to how we see the benefit of it to the company?
Yes.
And the benefit to the customer is the whole reason we're going down this path is, if you go back, is to be able to enter into this transaction to benefit two customers who want to participate in the renewable marketplace, supports economic development, and supports not only for those customers a retention case, but it also supports an economic development argument and go out to other customers and try to recruit customers to our service territory, that we can enter into these transactions. So I would argue if we're successful, and this is helpful even in a small extent in bringing other customers to the service territory, that is a benefit to all customers. Second point I would make is, again, it provides that fuel hedge that I just described for the customers. That's the benefit to them, while ensuring that they never pay any more than they would have otherwise. But if fuel prices, if fracking were banned, for example, and natural gas prices go up, this would be a very nice hedge for customers, although small, 25 megawatts. It would be a nice hedge for the customers that they can get without any risk of paying more than they would have. And the last point I would make is that we think that is very reasonable, and it's also what the companies are trying to figure out a way that we can support our underwriting of that risk, given that we won't recover that in any form. And that was our concern, is trying to get an agreeable proposal with the Commission that accomplishes all those objectives that will allow the companies to move forward. Toyota and Dow they appreciate the dilemma we're in and the circumstances around that dilemma, but they want to move forward. They're willing to move forward. So if we can get a proposal that is consistent with what we've laid out, that will benefit the customer in the ways I described. But if we don't move forward, we can't deliver any of those benefits. We, the companies, if we don't move forward this proposal, we won't be able to deliver any of those benefits to our customers on the whole, as I've explained, or to Toyota and Dow specifically.
Okay. And the 25 megawatts, what's your estimate for how many hours of that 8,760 those are available? Is it?
So we've assumed this solar installation will be bifacial panels, I believe they're using in this case. And so we assume that around 24 to 25% capacity factor would be available from this facility.
Okay. And I was just scratching down some questions earlier, so these may not seem to be, they're going to seem one-off. In the example, I believe Mr. Conroy suggested that the modeling said that fuel costs would change, but the REC price would be constant over the 20, did he say over the 20-year period or over the month?
The 20-year period is what we've assumed, but we just took a look at the REC prices are, if you look at the forward curve, which is available for, let's say, 2 to 3 years out, they're ranging between $9 and $10 today. But you're correct in your assumption, they would not be the same. We just produced a variety of scenarios, assuming different REC prices, so one could kind of look at that range and the impact that it would have on the analysis.
Okay. Will that be in the 48 scenarios? Because I really thought that during that explanation he said, remember, REC prices won't change. Maybe I heard that wrong.
Let me see if I can clarify what I was trying to say is there are 48 scenarios in Mr. Sinclair's analysis. One set is at 0 REC prices, one set's at $2 REC prices, one set's at 4 and 6. I don't believe that those REC prices over the 20-year period of each of those scenario analysis changes.
Okay.
That could be wrong.
You're correct, Mr. Conroy. There is a low and base and high fuel scenario, and then deviations of that with a 0 CO2 price, a high CO2 price, and then further deviations of that with 55-year and 65-year coal lives, respectively. All of those, Mr. Conroy's point, run against a constant 0 price REC assumption, a $2, a $4, and a $6. And I'll continue to point out that they're currently around $9 that we could achieve, between $9 and $10 for RECs.
Okay, so it's a simplified assumption for your modeling, which, and back to the original discussion I believe the Vice Chairman had about whether, I think the question was asked, would the 25 megawatts available 24 to 25% of the time impact unit commitment? And I think the answer was no. That's a small amount of energy going into the system.
Correct.
How about 110 megawatts? Will that impact unit commitment? Because that's really what you have on the system if this project goes through, right? The 10 megawatts at Brown. I guess it's more than 110 megawatts because I forget Simpsonville.
Correct. So you were probably off for part of that discussion. So one of the learnings that I went through with Vice Chair Chandler that we would gain from this is that very fact of what levels of solar generation would suggest that we change our unit commitment. We do not believe that 100, 110, or 112 or 14, wherever we get to with solar share, would do it. Part of that explanation would be the lack of geographical diversity in the bulk of that capacity, the 100 megawatts. And so the dependability of that would be, we suspect, we'll experience it if we move forward, but we suspect, and we did our evaluation along this thought process, is that given that it's in one location and the other amounts are relatively small, 10 megawatts at Brown and up to 4 megawatts at Solar Share, that we wouldn't alter our unit commitment in dispatch because, as we all appreciate, even on a sunny day, the 100 megawatts from that farm could go to 10 in an instant with a cloud coming over and blocking out the solar irradiance. So now, at what level? We did have a discussion. Would that begin to impact our dispatch? We will learn from integrating the 100. We can extrapolate from that. We can look at the dispersed solar irradiance we would have at our Brown facility, where this facility IBB is considering constructing, and our Solar Share, and begin to make those types of calculations. But it would be well beyond 100 megawatts, and those megawatts would need to be dispersed, was the gist of the conversation that we had.
Okay. And I did hear that. I went off for just a minute during the 2-year, 20-year conversation in the last round of questioning. So if I'm looking at the impact on your operations of this maximum 114 megawatts, knowing that the way it's on the system and a cloud or a cloud formation could have a huge impact because of the lack of geographic diversity, you're going to have natural gas being used for balancing, right?
In some hours, yes. In other hours, if load was low enough, it could be a coal unit following that load, correct?
Okay.
Could be both.
Coal doesn't do a great job of following, correct?
The response time of coal units varies, as you know, and it would not be able to respond as quick as some other units, yes.
So I believe, thinking back, someone in the original hearing had the question of whether or not this would impact the life expectancy of any of your coal units by making them go into a load following scenario. And I can't imagine this small amount of megawatts would do that.
No, you also have to remember our units follow our native load, which can vary by those same increments. I think we're all talking, in this case, about relative increments, 100 megawatts or so, and we serve loads that are, variable, very similar to solar on the reverse side. We serve loads that have that same variability. But you do bring up a broader point, and as we would integrate more and more solar onto the system, there could be impacts to the way our units have to operate. But given the levels that we're talking about here, we don't see that to be the case. We also see, I know I keep pointing it out, but if solar is geographically dispersed, that helps with that action also, because you don't have the intermittency as pronounced if you had, let's say, 10 megawatt solar farms spread across the state. That capacity would be, and energy would be more dependable on a second-by-second basis than it would be all in one location. I think that makes sense.
Right. I think that's all the questions I have.
Okay. I have no questions. Mr. Riggs, do you have any follow-up?
No, Your Honor, I do not.
What about Mr. Cook? Anything?
No questions, Your Honor.
Ms. Bensel, anything further?
No further questions.
So there will be a few post-hearing data requests, correct?
Yes, there will be.
Mr. Chairman,
Yes. Oh, I didn't ask you, Mr. Chandler.
No, my fault. I'd just gone. I do have one question I want to clarify a previous one. Mr. Beller, I asked earlier about the likelihood of purchases under the PPA as being non-economy or economy under the current definitions of the FAC review. Do you remember that?
Yes.
And my question, I believe, turned on what are the expectations of the highest unit available in any given month being less than $28, and you said that not going to happen, right?
Correct.
Let me ask an alternative. What's the expectation that the highest unit even available is less than $28 in any given hour?
The answer would be the same. In all likelihood, the highest unit that we would have available in any hour would be greater than $28. The only exception would be if we had an outage at one of the higher cost unit facilities, and obviously in those hours, a combustion turbine given the right, a larger combustion turbine given the right gas price profile could be below $28. But as a general rule, we would expect that cost on an hourly basis to be greater than $28.
And would you agree, and I think Mr. Sinclair's analysis may bear this out, but would you agree that the expectation or the likelihood of the highest unit cost in each hour is going to be, that it's likely that amount is going to be increasing over the 20-year period?
Two things to answer that question. We would say that our highest cost unit available, that fuel prices are going to increase. So that unit the cost of the highest price unit available to serve load, we would suspect would increase over time, to answer one part of the question. And then Mr. Sinclair also states that our overall hourly incremental cost of generation, not just what units are available, but what units based on economic dispatch we choose to serve load, that cost would also increase. To answer your question specifically, yes.
The expectation is that the variable O&M and variable fuel costs are likely to increase. It's inflation, right? I mean, that's effectively the increase in expense for both of those items is expected to increase over the 20-year period.
Correct.
Yeah. Thank you, Chairman.
Anyone else have any additional questions? If not, Ms. Vinsel, how long will it take you to draft what you perceive to be the post-hearing data request?
The post-hearing data request can be issued by close of business on Thursday, October 29th.
Mr. Riggs, how much time will you need to respond?
Probably 10 business days, Your Honor, through November 12th.
Okay. All right, Mr. Riggs, would you like to prepare a brief or allow the matter just to be submitted on the record?
Your Honor, I'd like to consult with my client, and if it pleases the commission, I will have counsel with a copy to the Attorney General an email advising you of our decision on that.
And yeah, suggest a time, and then if the Attorney General's office desires to file a brief, well, we'll give them whatever time, same time that KU and LG&E has, and then they can file a brief or file a notification in the record they don't intend to file one, at which time then the case will stand submitted. Fair enough?
Fair enough, Your Honor.
Is there anything else? Mr. Riggs, Mr. Cook, Ms. Vinsel?
Nothing.
If not, all right, this hearing is adjourned. Thank you.
Thank you, Your Honor.